Every single year, hundreds of thousands of people in Sweden put their hard-earned money into investments and walk away with less than they started with. Not because they were unlucky, not because the market crashed, but because they were following advice that was never designed to make them rich. It was designed to make someone else rich. If you're interested in money, finance, or changing your financial future, like this video and subscribe right now, because what you are about to learn can change the way you see money forever. I want you to imagine someone. Let's call him Eric. Eric is 34 years old, lives in Stockholm, works a solid job, earns a decent salary. By most people's standards, Eric is doing fine. He's not rich, but he is responsible. He doesn't waste money. He saves. He even invests. Every month, Eric sends a chunk of his paycheck into the Swedish stock market, into a few popular funds, into some well-known Swedish companies. He does what every financial article told him to do. He is, by every definition, a smart investor. And yet, after 4 years of doing everything right, Eric sits down one evening, opens his investment app, and realizes something devastating. His portfolio has barely grown. After fees, after taxes, after inflation quietly eating away at his money like termites in the walls of a house, Eric is essentially in the same place he was 4 years ago, maybe even slightly behind. 4 years of discipline, 4 years of sacrifice, and almost nothing to show for it. Here is the part that will really shake you. Eric is not a rare case. Eric is the average Swedish investor. Now, before I explain what is actually happening here and why so many people fall into this exact trap, I need to tell you something that most financial channels will never say out loud. The system that most Swedish investors are using was not built for the investor. It was built for the institution. And there is a very big difference between those two things. But first, let me take you back to something that happened that completely changed the way I personally think about money. A few years ago, I was sitting with a friend, smart person, university educated. She worked in healthcare, saved religiously, and had been putting money into Sweden's most popular investment funds for about 6 years. We were talking about money, which is always a slightly uncomfortable conversation, and she mentioned she felt like her investments were going nowhere. So we sat down and actually looked at the numbers together, and what we found was almost embarrassing, not because she had done something wrong, but because she had done everything exactly right according to the advice she had been given, and that advice had quietly cost her tens of thousands of kroner over 6 years, not through some dramatic crash, not through some obvious mistake, but through something much more invisible. I'll tell you exactly what we found in a moment. But first, you need to understand why most people never even notice this happening. Here's the truth about how most people learn about investing. They hear something from a colleague. Maybe they read an article in Aftonbladet or Expressen about which stocks are hot right now. Maybe their bank sends them a glossy brochure with confident-looking people smiling over graphs that go up and to the right. And so they take that advice because it feels professional, because it feels safe, and because it feels like the kind of thing responsible adults do. But there is a massive problem hiding inside all of that comfortable, familiar advice. The most common investing behavior in Sweden right now is what I call comfort investing. And comfort investing is a quiet wealth killer. Let me explain what comfort investing actually is, because this is the first big trap that most people fall into without realizing it. Comfort investing is when you choose an investment not because it is the best option for your money, but because it feels familiar, safe, and socially acceptable. It's putting money into Swedbank's recommended funds, because Swedbank is where you've had your account since you were 16. It's buying shares in Ericsson or Volvo because they are Swedish companies and they feel reliable. It's choosing the fund with the prettiest interface on the app your friend recommended. None of these decisions are based on actual financial analysis. They are based on comfort. And comfort, in the world of investing, is almost always expensive. And this is where most people fail without even realizing it. Here is something you have probably never thought about. When you invest in a managed fund, which is one of the most common ways Swedish investors put their money to work, you are not just investing in the market. You are also paying someone to manage that investment for you. That person charges a fee. In Sweden, many popular actively managed funds charge anywhere between 1% and 2.5% per year in management fees. Now that might sound tiny. 1%, almost nothing, right? Let me show you why that small number is actually enormous. Imagine you invest 100,000 kroner. Over 25 years, if your fund earns an average of 7% per year, which is a reasonable historical average for a diversified stock portfolio, you would end up with about 543,000 kroner. But if you are paying 1.5% in fees every year, your actual return drops to about 5.5%. And at 5.5% after 25 years, your 100,000 kroner grows to roughly 380,000 kroner. That is a difference of 163,000 kroner. Vanished. Not into the market, not into any risk, just gone into management fees. Over a lifetime of investing, this difference is not tens of thousands of kroner. It is hundreds of thousands. For many people, it is the equivalent of several years of salary, just silently drained away. But here's the part that will really make you stop and think. Study after study, including research done here in Sweden by the Swedish Financial Supervisory Authority, the Finansinspektionen, has shown that the vast majority of actively managed funds do not outperform the market. They charge you a premium fee to deliver average or below average results. You are paying extra for someone to make decisions that, statistically speaking, a simple index fund would outperform over the long term. So why does this system continue? Why do banks keep selling these products? Why do advisors keep recommending them? Because the fee is not coming out of your pocket in a way that hurts. It is quietly subtracted from your returns. You never write a check for it. You never see it as a line item on your bank statement in a way that feels real. It is invisible. And invisible costs are the most dangerous costs of all. Now let me go back to my friend. When we sat down and looked at her investments that evening, this is exactly what we found. She had been investing in 3 different actively managed funds, all recommended by her bank. The combined average fee across those funds was about 1.8% per year. Over 6 years, that had cost her approximately 47,000 kroner in lost compound growth. Not in fees, she could easily see, but in returns, she never received because that money was quietly being siphoned out of her portfolio year after year. 47,000 kroner. That is a trip around the world. That is a deposit on a car. That is almost half a year's salary in Sweden for many workers. Gone. Not because she did something reckless. Gone because nobody told her to look. But here is something even more unsettling than fees. And this is the part that most financial content creators will skip over because it is uncomfortable. Sweden has a specific investing problem that almost nobody in the international finance community talks about. And it has to do with something called home bias. Home bias is what happens when investors, consciously or unconsciously, put a disproportionately large amount of their money into their own country's stock market. It feels natural, right? Swedish investors buying Swedish stocks. But here's the problem. Sweden is a very small economy in the context of the global stock market. The Swedish stock market represents less than 1% of global market capitalization. And yet, research suggests that Swedish investors on average hold somewhere between 40% and 60% of their equity portfolios in Swedish stocks. They are essentially betting the majority of their financial future on a market that represents less than 1% of the world's opportunities. And now, think about what that means for risk. When a Swedish investor is heavily concentrated in Swedish stocks, they are exposed to Swedish economic cycles, Swedish currency risk, Swedish political decisions, and Swedish industry performance. If Ericsson struggles, if the Swedish property market wobbles, if the krona weakens significantly against the euro or the dollar, that investor feels it everywhere. Their job might be affected, their housing value might be affected, and their investment portfolio is affected too. They have no cushion, no diversification, just massive invisible concentration risk wrapped in a feeling of familiarity. This is where everything changes. Because once you understand home bias, once you really sit with the fact that concentrating your investments in one tiny corner of the global market dramatically increases your risk while doing almost nothing to increase your potential return, a completely different picture of investing starts to emerge. And I want to paint that picture for you right now. Let me introduce you to a second person. Let's call her Layla. Layla is also 34. She also lives in Sweden. She also earns a similar salary to Eric. But Layla made a few different decisions about 5 years ago, and those decisions have completely changed her financial trajectory. Layla does not invest in actively managed funds. She does not call her bank for investment advice. She does not follow hot stock tips in financial magazines. Instead, Layla put her money into 3 simple things. A globally diversified index fund with ultra-low fees, a small allocation to REITs, which are real estate investment trusts, global real estate funds that pay regular dividends, and a small emergency buffer in a high-yield savings account so she is never forced to sell her investments at the wrong time. That is it. No complexity, no drama, no monthly meetings with a financial advisor who makes commissions on what they sell her. And over 5 years, while Eric's portfolio barely moved after fees, Layla's grew by just over 60%. Same economy, same market conditions, different decisions. I will explain exactly why Layla's strategy works so well in just a moment. But first, I need to address something that is probably already forming in your mind. You might be thinking, okay, but what about the risk? What about volatility? What about the market going down? And that is a completely fair question. But here's the thing that most people get backwards about investing risk. The idea that putting your money into a familiar local market or into a managed fund with a smooth-talking advisor behind it is safer than investing in a globally diversified index fund is one of the most expensive. Misconceptions in personal finance. Safety is not familiarity. Safety is diversification. Safety is low fees. Safety is time in the market. And safety is understanding what you own and why. When you invest in a globally diversified index fund, you are not betting on one company. You're not betting on one country. You're buying a tiny piece of thousands of companies across dozens of countries and industries. You are buying the entire engine of global capitalism. And historically, over long periods of time, that engine has always moved in one direction, forward. But nobody talks about this part. Here is the psychological trap that keeps most Swedish investors stuck. And I want you to really feel this one because it is subtle, but it is powerful. When we see our investments go up, we feel smart. When we see them go down, we feel scared. And when they go sideways, which is what happens when fees quietly eat your returns, we feel nothing. We feel like nothing is wrong. And that is the most dangerous feeling of all in investing, because it gives us no signal to change. Eric felt fine for 4 years. His money was invested. He was doing the responsible thing. He had no emergency, no crash, no dramatic loss that would shake him awake. He was just slowly falling behind in a way that felt like standing still, and that comfortable numbness kept him loyal to a system that was quietly failing him. This is the real wealth trap, not poverty, not ignorance, not laziness. It is the comfortable middle ground where you feel like you are doing okay, and okay costs you everything in the long run. Let me give you a reality check that might sting a little. If you are a Swedish investor right now and you're holding your money in an actively managed fund with fees above 0.5% per year, you are likely losing tens of thousands of kroner over your investment lifetime, compared to simply switching to a low-cost index alternative. If you have more than 40% of your portfolio concentrated in Swedish equities, you are carrying more risk than you probably realize for less diversification than you deserve. And if you are making investment decisions based on what your bank recommends, you need to understand that your bank is not a neutral advisor. Your bank is a business, and your money is its product. Now, I know that sounds harsh, and I'm not saying this to make you feel bad. I am saying this because nobody else will say it this clearly, and you deserve to hear it. Here is the good news, and I mean genuinely good news, not just YouTube good news to make you feel better before the video ends. Fixing this is not complicated. It does not require a financial advisor. It does not require a degree in economics. It does not require you to watch the market every day, or read charts, or understand complex derivatives. It requires 3 things: understanding the problem, making 1 or 2 simple changes, and then, most importantly, doing almost nothing for a very long time. Let me walk you through what a simple, effective investment approach for a Swedish investor actually looks like in practice. The foundation is a globally diversified, low-cost index fund. In Sweden, you can access these through platforms like Avanza or Nordnet. You are looking for funds that track the global market, something like a global index fund that follows the MSCI World Index or a total world index. These funds give you exposure to thousands of companies across North America, Europe, Asia, and emerging markets. The fees on these funds are often between 0.1% and 0.3% per year. That is 10 to 15 times cheaper than the actively managed funds most Swedish banks push. The second piece is a small allocation, maybe 10 to 20% of your portfolio, into something that generates income. This could be global dividend ETFs, global rate funds, or even a simple bond index fund if you're closer to retirement. The goal here is not to get rich quickly. The goal is to create a small stream of passive income that gets reinvested, which accelerates compounding over time in a way that feels almost magical once you understand it. And the third piece, which is the one nobody ever mentions because it is not exciting, is cash. A real emergency fund. 3 to 6 months of living expenses sitting in a high-yield savings account separate from your investments, untouchable except for a real emergency. Because here is why this matters in an investment context. The single biggest mistake investors make during a market downturn is selling their investments at exactly the wrong time because they need cash. If you have an emergency fund, you never have to sell at the bottom. You can sit calmly while everyone else panics, do nothing, and let your portfolio recover. That single decision, having cash available so you never need to force sell, is worth more to your long-term returns than almost any clever investment strategy. But what happened next with Eric changed everything. About 6 months after that evening, where we looked at my friend's investments together, I shared some of what I had learned with Eric. I showed him the fee comparison. I walked him through the concept of global diversification. I explained why his home bias was silently concentrating his risk in a market that represented less than 1% of the global economy. And at first, Eric did what most people do. He pushed back. He said his bank's funds were trusted. He said he felt comfortable with Swedish companies. He said the global market felt risky and uncertain. And I understood that completely. Because changing how you think about money does not happen in one conversation. It is not a single moment of clarity. It is a gradual shift, like slowly adjusting your eyes to see something that was always there but hidden in the dark. But 3 months later, Eric made some changes. He moved the majority of his portfolio into a global index fund with fees under 0.2%. He kept a small position in Swedish equities, maybe 15%, because he understood them and felt comfortable with a small home allocation. He built up a proper emergency fund, and he stopped checking his portfolio every day. He started checking it every 3 months instead. Now, fast forward 18 months. Eric's portfolio has grown more in those 18 months than it did in the previous 4 years combined. Not because the market magically changed, but because the quiet drain of fees was stopped, the drag of under-diversification was reduced, and compounding was finally allowed to do its work without interference. Here's the insight that I want you to carry with you after this video. The secret to building wealth as an ordinary person, a salary worker, a middle-class family, a student starting out, a person who feels like they can never quite get ahead, is not finding the right hot stock or the right brilliant advisor or the right moment to buy. The secret is removing the invisible costs, the silent drags, the comfortable traps that quietly steal your future one small percentage point at a time. Wealth is not usually built through grand gestures. It is built through boring, consistent, low-friction decisions repeated over a very long period of time. And the most powerful thing you can do right now, today, is simply stop paying for things that are silently working against you. There is something I want you to do before this video ends. And no, it is not going to be download my course or sign up for my newsletter. It is something simpler and more powerful than either of those things. I want you to go and look at every investment you currently hold. Find the annual fee, which is usually called the management expense ratio or förvaltningsavgift in Swedish. Write it down. Then look at your asset allocation and see how much of your money is in Swedish stocks compared to global stocks. Just look. Just become aware, because awareness is the beginning of everything. Most people will never do this, not because it is hard, but because looking at the truth about your money requires a certain kind of courage. It requires being willing to see that the safe choices you made might not have been as safe as they felt, and that is uncomfortable. But sitting in that discomfort for 5 minutes is worth far more than years of comfortable numbness. And here's the thing about the Swedish financial market specifically that I think is really important to understand. Sweden is a remarkably well-educated country when it comes to many things. But financial literacy, real financial literacy, not the kind you get from bank brochures, is still shockingly low. A 2023 survey by the Swedish FSA found that only a minority of Swedes correctly understood concepts like compound interest, diversification, and investment fees. And this is not a failure of intelligence. It is a failure of access to clear, honest, simple information. The financial industry benefits from complexity. When investing feels complicated, people defer to professionals. When they defer to professionals, those professionals earn fees. The complexity is not an accident. It is a feature of a system designed to make you feel like you cannot do this yourself, but you can. And it is much simpler than they want you to believe. Let me bring this home with one final thought. Imagine 2 versions of your life. In one version, you keep doing what you are doing right now. You leave your money in whatever it is in. You trust the process because it feels safe. You never really look too closely at the fees, the diversification, the invisible costs. 20 years from now, you have some money, but not as much as you could have had. Not enough to be truly free, not enough to change your life or give your children a different starting point, just enough to feel okay. In the other version, you spend one afternoon this week looking at your investments. You make 1 or 2 simple changes. You move toward lower fees. You move toward global diversification. You build your emergency cushion. And then you let time do the heavy lifting. 20 years from now, the difference in those 2 paths is not small. For the average Swedish investor, we are talking about a difference of hundreds of thousands of kroner. In some cases, the difference between retiring when you want to versus working years longer than you planned. Those 2 versions of your life are separated by nothing more than information and a decision. You now have the information. The decision is yours. The most painful financial mistakes are not the dramatic ones. They are not the gambling losses or the obvious scams. The most painful ones are the quiet ones. The invisible fees paid year after year, the diversification never taken advantage of, the emergency fund never built so you had to sell during a crash. The years lost to a comfortable complacency that felt like wisdom. Do not let that be your story. You came to this video today for a reason. Maybe you felt like your money was not moving the way it should. Maybe you had a nagging feeling that something was off. Maybe you just wanted to understand your situation better. Whatever brought you here, I hope you leave with something real and useful. Not fear, not anxiety, but clarity. The kind of clarity that helps you take one small, powerful step in a different direction. Because one step is all it ever takes to start walking somewhere better. If you learned something new today, make sure to subscribe to Money Insights and like this video. More powerful financial truths are coming next.